Did you know there are half as many stocks in the stock market as we had in 1996? Why is that? Well, 86% of the companies that have at least $100 million in revenue are still private. This trend has been evolving over a couple of decades. You see, to go public, you have to do an IPO, or an initial public offering, to be listed on the stock market. Once you get on the market, you have to do all kinds of reporting to the SEC and other government regulations. You also have to meet or beat quarterly earnings in order to try to keep your stock price up. That's a lot of pressure for a CEO and a management team. However, if you stay private longer, you don't have as many reporting requirements. And investors are pouring a lot of money into private equity funds. Now, there are some good reasons to do so and some not so good reasons to do so. A negative for investors that are putting money into private equity is that it's just not as transparent. Since there aren't as many governmental reporting requirements, there's not as much scrutiny. But since there aren't as many stocks on the stock market anymore, building a diversified portfolio might become harder for some investors. For that reason, they might look at allocating a portion of their portfolio to private equity. By doing so, you might be able to get exposure to returns earlier in the business life cycle than waiting for the company to go public. However, there are some downsides, and some of them are pretty big. Many times investments in private companies are illiquid for years or perhaps a decade or more. Also, most private equity investments require a level of investor sophistication. You may have to have net worth or certain income requirements to have access to those structures. And anyone that allocates money to these private structures should really be thinking about it in the context of their overall portfolio and their financial plan. The last thing you want to do is tie up capital in investments that you can't access when you need it.